Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today with our weekly wrap-up. Graham, tell us a little bit about what's been going on in the market this past week.
Yeah, thank you, Stacy. Thanks for our listeners watching the call. Yeah, I mean, we continue to see stocks under pressure. I mean, we got heightened tensions. I mean, that's putting it lightly. Over in the Middle East, we saw interest rates really soaring, just really putting a lot of anxiety, obviously, on the consumer, on the markets, so on and so forth. So we saw the S&P, the NASDAQ, the Russell all off about 2 to 3%. So we saw about 9 of the 11 S&P sectors losing ground. And that was really led by consumer discretionary and real estate off about 4.5%. On the flip side of that, from a commodity standpoint, we saw gold jumping about 2.3% and oil moving up about 0.5%, a lot because of the tensions that are going on, the geopolitical events overseas. So we saw the U.S. Treasury yield pop up nearly about 5% at or just above that. Keep in mind that this is the continued effort by the market to reinvert this yield curve. We've been in an inverted yield curve. We're trying to reinvert it. Unfortunately, or fortunately, we're pulling the Band-Aid off and trying to do it pretty quick. At the same time, we did see Fed Chairman Powell come out and did acknowledge that we are seeing some cooling inflation. It's coming down. I think that's really obvious, though, right? We're coming down from the mid-9s of last year to about 3.7%. We just got to get over this next little hump because they do have a mandate of about 2%, but they do acknowledge it's going to be tough. If you still have a strong consumer who is employed, they're feeling good about their savings, they're more likely to spend. And as more likely as they are to spend and employment isn't moving up, it's going to be hard to get it down to that 2% inflation mandate that the Fed Reserve has. So if we look at what might help this, I think it might go a long way, is my opinion, is the 30-year fixed mortgage. For most consumers, that's the largest asset is your home. And that has moved up to 8%. Now, that's the highest level we've seen since year 2000.
Well, Graham, how might that 30-year fixed mortgage rate impact the housing market and consumers?
Well, let's think about it. If that's the largest asset that most consumers have, right? And let's say they go out and they get a mortgage now and it's 8% by choice or not. Maybe they just have to move for work or, whatever might happen. That's going to be less money they have to spend on other maybe services, trips, so on and so forth. They go to the gas pump. They already see that it costs more to put fuel in the car. They go to the grocery store. They already see that it costs more to fill that basket up to feed their family. So you start adding up all these things, and it is bringing down inflation. It's just this next little level that the Fed wants to get to. It's probably that toughest part, what I often say, the stickiest part to overcome.
Okay.
So on that, we did see U.S. housing starts rebound in September, but building permits dropped about 4% month over month. But this is the key for that 8% mortgage rate. Existing home sales dropped to about a 13-year low. Why? Because why leave that 2.5, 2.6, 3%, heck, 4%, whatever it is, wherever you refinanced at the low level in 2022, you're not likely going to want to just move for the sake of it and go grab an 8%. So that's really holding that side of the market hostage. That's where you're seeing the recession, not in the overall economy. But if we go overseas, we're looking at the British CPI remaining unchanged at about 6.7% year over year. If we look in Europe general, we're looking at Germany. Investors maybe had some moral improvement here, but they still have an economic situation that's really challenging, hard for them to overcome at this particular point. We go a little bit further and look at China. We are seeing some signs of some stabilization in the GDP. We saw a growth about 4.9% year over year for that Q3 quarter.
Well, Graham, with everything that's going on geopolitically and with the economy, what should investors do?
You know what? I think the biggest thing is don't panic. If you got a plan, stick with your plan. You can always fine tune around the edges, but don't panic out of your plan. And most of us have a long-term plan. if you have a need for short-term money in the next couple months, 6 months, 1 year, hey, maybe you take good advantage of some of these high CD rates or money market rates or cash equivalent rates, but don't leave your plan. You have a plan in place. These things come and go. As horrible as they are, this will go, something else will come in its place down the road. The market is always climbing a wall worry. Don't let it affect your long-term plan.
Okay. And
Yep.
what about with so much money in cash and cash equivalents funds? What should investors consider with regard to that?
Well, it's great. I mean, that's been an option that we haven't had for 16 years, a decade, whatever. So I get it, right? The bond market, you haven't had high rates in the bond market like we are now because rates went up so much. They pushed bond prices down. So now you can get paid to own bonds. You might even have an opportunity here, maybe sooner than later, to get some capital appreciation. Now, we all need interest rates and the Fed to pause and maybe start to lower to really get the full effect of all that. But if we don't go to a deep protracted recession, or even if we do get into a much slower growth period, that maybe not be deep protracted in terms of a recession, maybe a light one, that could still be really good for bonds. So I think the risk here for investors keeping so much in cash and cash equivalents is they're going to lose the opportunity, that reinvestment risk of getting higher income somewhere else and potential capital appreciation in those bond areas.
All right. Well, thank you so much,
You got it.
Graham. And thank you to our viewers for joining us today. We hope you have a great week, and we'll look forward to seeing you again next week on the weekly wrap up. Have a great day.